I think it's fair to say, or rather a huge understatement to say, that the landscape of M&A activity has changed significantly due to COVID-19. M&A activity seems, to a large extent, to have either stopped due to market uncertainty, continued to take advantage of opportunities which arise, or there are ongoing transactions. These will have been impacted by changing markets. Whether there is M&A activity or inactivity, disputes will arise. It's just the form and substance of the disputes which may change. Where there are disputes, there will often be a damages expert in assessing a party's claim. In this presentation, I'm going to talk about a number of areas where COVID-19 has had an impact on M&A disputes from the viewpoint of an expert. This will necessarily be relatively high level, as we only have time to touch on some of the key issues. What I will say at the outset is that while COVID-19 has made the landscape more difficult for M&A activity and related disputes, it's also made the role of the expert more challenging. So the top causes of M&A disputes can be categorized between pre- and post-closing disputes. And these include, for pre-closing disputes, failure to complete, and generally here we're talking about the purchaser. And post-closing disputes, being closing price adjustments, failure to disclose or fraud, misrepresentation and breaches of warranties, earn-out and indemnity. Since the end of the global financial crisis, M&A related disputes have mainly related to post-closing issues. This is because, in general terms, the occurrence of failure to complete claims increases in volatile markets. This can be illustrated by a simple example. In a stable environment, if a purchaser pulls out of an SPA, aside from wasting time and costs, there are no outside factors which would have caused a material impact on the value of the target. The sellers can look for another buyer. In a volatile, in this instance, falling market, if a purchaser pulls out of an SPA, the value of the target will likely be falling, so the value of the seller's asset is falling. This depreciation value will not likely be recoverable from another purchaser, at least in the short or medium term. The disputes I'm going to focus on in this presentation are failure to complete, closing price adjustments, specifically working capital-based adjustments, and a failure to disclose or fraud. Looking at these three types of disputes will allow me to identify the three most commonly required technical disciplines for expert assistance, being valuation and accounting, which is both in the failure to complete and the close closing adjustments disputes, and then both valuation accounting and investigations, which are part of the failure to disclose or fraud disputes. Although in reality, M&A disputes often require an expert who is experienced in all three disciplines. So, looking at failure to complete. Certainly seeing an increase in failure to complete claims with the purchasers pulling out of transactions prior to closing. So, you've got two parties entering into an SPA for the sale and purchase of a target company. As we all know, there can often be a long time between parties entering into an SPA and the closing date. The issue with these time lags is that they allow volatility into the equation. Where the signing and proposed closing date of the SPA straddle the start of COVID-19, a significantly worsening economic environment will have impacted the value of many companies. For a purchaser, a purchase price agreed pre-COVID will likely not look as enticing as it will post-COVID. We're seeing a large number of stated reasons for purchasers failing to complete transactions, including those that are specifically related to or referencing COVID-19, being force majeure, material adverse change, failure to obtain funding, and then those which ostensibly are for non-COVID related reasons, but probably have underlying reasons driven by COVID, which include regulatory issues and failure of the sellers to meet obligations. The merits of such arguments obviously differ, but what I'd just like to touch on quickly, as it generally requires expert analysis, is material adverse change. The terms of a material adverse change clause can obviously vary, but in general terms, it requires the assessment of 3 elements, which were identified in the 2018 Acorn litigation in the Delaware Chancery Court. These are firstly the magnitude of decline. This will likely be met due to the impact of COVID-19. Next is the duration of the decline. While the impacts may well be ongoing, the long duration could create uncertainty and the fact there may not be a clear path to recovery. Now, where it possibly becomes a bit more sticky is in relation to the third point, which is the degree of disproportionality of the event to the target, of the event on the target in comparison to competitors or in the industry as a whole. This is where a question may arise of the ability to pursue the MAC claim. A full analysis will have to be undertaken to assess whether there are specific factors which disproportionately impact the target, including an analysis of the historic financial performance, an analysis of the industry and competitors, a review and update of the short and long-term forecasts, and also to consider changes in valuation inputs such as discount rates. Now, looking at damages. So, okay, a purchaser has failed to close the SPA and the contract has been terminated. What is the loss to the seller? The general approach to calculating damages is to assess the difference between the position the seller is actually in as compared to the counterfactual position it would have been in had the transaction closed as envisaged by the SPA. For the counterfactual scenario, I always used to say, let's start with that because it's more straightforward. After all, we have an SPA which sets out the purchase price. However, assuming we're looking at an SPA which includes a purchase price adjustment based on completion accounts rather than the lockbox transaction, there will need to be an adjustment for closing accounts to accurately reflect what would have happened and the sums that would ultimately have been received. There's obviously some complexities there, and I'll discuss that in the next section when I consider the closing price adjustments. When we're looking at the actual scenario, well, the date of breach can be considered to be either the date of termination of the SPA or the stated closing date. It's not correct to assume that that is the date at which the actual value of the business should be assessed. Fair market value is defined as the price a willing buyer would pay and a willing seller would accept. There is no willing buyer anymore at the date of breach. The buyer's pulled out of the transaction. Therefore, should the starting point be the loss to the seller is being 100% of the purchase price? I mean, that's the impact. However, the seller is still in possession of the target company. So one needs to consider the value of the target retained by the seller. Now, this can only be fully assessed by using hindsight in the actual scenario. Now, hindsight is often a contentious and a dirty word to use in valuation disputes, but this is in respect to the counterfactual scenario. For the actual scenario, the full consequences of a failure to complete can only be assessed if hindsight is used. The impact on the transaction of the seller does not occur at a snapshot in time at termination. Rather, the value of the retained target will only be known by reference to a willing buyer once that can hypothetically be found. After all, it took the seller and the purchaser a long time to get to the point of termination. A new willing buyer cannot be found instantly, especially in a volatile market. Moving on to closing price adjustments. In considering closing price adjustments, I'm going to focus on adjustments based on working capital, i.e. movements in net current asset position of the company, being the current assets less current liabilities, which is one of the most commonly adopted approaches. Where there is volatility in a target's market, there may be questions as to whether closing accounts accurately reflect the financial position of the target. While the jurisdiction can impact the treatment of subsequent events, the reality of the impacts may be similar. For example, in the US, the Financial Accounting Standards Board's subsequent events guidance provides that subsequent events and their effects should be recognized in financial statements where there is evidence that conditions existed at the date of the balance sheet. Whereas the international financial reporting standards specify that working capital is derived from a balance sheet limited to accounting for those conditions that existed at the closing date, but which are informed by additional information learned after the date of preparation of the financial statements that reflect those conditions. So there is a slight nuance there between the different approaches. However, in reality, they can often lead to similar results. This, therefore, leads to close scrutiny as to whether the closing accounts accurately reflect the position and expectations of the position of the relevant date. So let's look at three of the usual key battlegrounds which take on additional significance and risk due to COVID-19. Starting with accounts receivables reserve. Due to volatility, which is happening across the market, the risk of bad debt is likely to increase. Therefore, one needs to consider whether the provisions for doubtful debts reflects the true risk of the market or whether an adjustment is required. Then looking at inventory reserves. Due to impacts on sales and/or the operations of the business, the risk of excess and obsolete inventory increases. Let's think about a clothing retail store which may have been shut for a couple of months. They will have missed most of the fashion season and so be carrying stock that would be unlikely to sell, at least not at full price. And then we've got cash. Has a seller received COVID-19 related funding? If so, this could artificially inflate the cash position. Also, a purchaser needs to consider whether the target has correctly received any government funding or whether a further liability may arise. When considering the impact of COVID-19 on closing price adjustments, an expert needs to consider, firstly, the date, so when the closing date was, and when any impact on the financial performance may have occurred, and location. The impact of COVID-19 will differ by region due to timing of the global spread of the pandemic. In considering failure to disclose or fraud, where financial performance has been impacted by COVID-19, a seller may feel compelled to withhold some information or even fraudulently represent a false position. While in some instances, specifically in fraudulent misrepresentation, the reparation sought will be the reversal of the transaction. In practical terms, damages are usually awarded with reference to diminution in value, i.e. the difference between the purchase price and the actual value of the target company received. In such situations, a detailed investigation will need to be carried out to prove that there was a failure to disclose or fraud. An example of this would be the claim advanced by Daiichi Sankyo against the Singh family and others on the sale of the generic pharmaceutical company Ranbaxy. It was shown that the sellers knowingly withheld a whistleblowing report, which ultimately led to the FDA ban on some of the Ranbaxy's drugs, and therefore a diminution in value. There's obviously an interconnection here between the valuation skills as the impact of any alleged failure to disclose or fraud needs to be assessed on the purchase price. Where this has occurred post-COVID, a number of challenges exist in assessing the counterfactual value of the target. Looking at the income approach, i.e. discounted cash flow, if one relies on historic performance, this may not currently reflect the market and the volatility. And future cash flows can be hard to predict. Turning to the market approach, historic transactions may not be representative of the current market, and also comparable company multiples may not fully reflect the impact of COVID-19 due to the availability of the results and the fact that volatility is ongoing. Now, there are obviously a myriad of other bases on which M&A disputes will arise which are impacted by COVID-19, which I've not had time to cover in this presentation. And these can include misrepresentations and breach of warranties, although this can also be tied to the issues already discussed, such as impact on closing accounts and potential failure to disclose. Got earn-out disputes. So they can often have poorly defined metrics. For example, do they include or exclude government support? plus uncertainties over timing of meeting targets. So does it give time to allow for recovery? And recovery, though, can lead to disputes. Then we've got disputes relating to indemnities. These relate to reimbursements for a specific loss, and COVID-19 can create uncertainties in valuation and cash flows. Now that's a very quick overview, but hopefully that gives you all food for thought. If there are any questions, I'll be here as part of the grand panel at the end, so please send them through. Thank you very much and stay safe.